What exactly are interest rates, and how do they influence the economy? At their core, interest rates are the cost of borrowing money, or the reward for saving it. Imagine you want to borrow $1,000 to buy a new laptop. If your bank charges a 5% interest rate, you'll end up paying $1,050 back over time. That 5% is essentially the price of accessing that money today, instead of waiting to save up. Now here's where it gets interesting. Interest rates aren't just numbers on a bank statement. They ripple through the entire economy. When rates are low, borrowing becomes cheaper. This encourages people to take loans for things like houses, cars, or even starting businesses. More loans mean more spending, which can lead to economic growth. Picture a garden. With the right amount of water, plants flourish. Low interest rates act like a gentle rain, fostering growth and activity. But what happens when interest rates rise? Suddenly, that same $1,000 laptop might cost you $1,100 if the rate goes to 10%. Higher borrowing costs can lead to people holding off on purchases, creating a slowdown in spending. Businesses might hesitate to expand or invest in new projects, just like a garden that receives too little water. It starts to wither. And here's the surprising part. These fluctuations in interest rates are often controlled by central banks, like the Federal Reserve in the US. They raise or lower rates to influence economic activity, aiming to strike a balance between growth and inflation. So, when you hear the term interest rates, remember, they are far more than just a borrowing cost. They are powerful tools that shape the entire economy. If this insight clicked for you, don't forget to subscribe for more clarity on how the markets work, which often results in reduced spending. Businesses might postpone expansion plans, and consumers may hold off on big purchases. This tightens the economic flow, slowing down growth. And here's the surprising part. These shifts don't just affect individuals, they reverberate through the entire economy. A small change in interest rates can lead to significant changes in job creation, business investment, and even inflation. So the next time you hear about interest rates changing, remember, it's not just numbers, it's a powerful lever that shapes how we all interact with the economy. How do interest rates actually influence the way we spend our money? Think of interest rates as a dial that controls consumer spending. Turn it up, and people tighten their wallets. Turn it down, and they're more likely to make big purchases. When interest rates are low, loans become cheaper. Imagine you want to buy a home. With a lower interest rate, your monthly mortgage payment decreases because you're paying less in interest. This means more of your budget can go toward other expenses, like furniture or renovations. So, you're not just buying a house, you're also spending more in the economy, driving growth. Here's the surprising part. When many people feel encouraged to make these kinds of purchases, it creates a ripple effect throughout the economy. Now, let's flip that dial to higher interest rates. Suddenly, loans are more expensive. That same house you wanted, the monthly payment is now higher because of increased interest. So, instead of rushing to buy, you might decide to wait or even stick with renting for now. This slows down spending not just on homes, but also on big-ticket items like cars and appliances, leading to reduced economic activity. Economists often refer to this as consumer confidence. When interest rates are low, confidence tends to rise because consumers feel more secure in their financial decisions. They're more willing to borrow and spend. Conversely, high interest rates can dampen that confidence, making consumers hesitant to commit to large purchases. Ultimately, the dial of interest rates significantly shapes our spending habits. When it's turned low, we're inclined to spend more, fueling the economy. When it's high, we hold back, which can lead to slower growth. Understanding this connection can help us grasp the broader economic landscape. How do interest rates affect business investments and growth? Think of interest rates as the price of borrowing money, just like a sale on a favorite gadget. When rates are low, it's like finding a great deal. Businesses jump at the chance to borrow money because it's cheaper. Imagine a new bakery looking to expand. With low interest rates, the owner can take out a loan for a new oven and a bigger storefront without breaking the bank. This means they can produce more pastries and hire additional staff. The bakery isn't just a local favorite now, it's becoming a community employer and innovating with new recipes to attract more customers. But here's the surprising part. When many businesses decide to invest in expansion at the same time, it creates a ripple effect throughout the economy. As these businesses grow, they buy more supplies, which helps suppliers expand too. This interconnectedness means that low interest rates don't just help one business, they can spark an entire wave of innovation and job creation across multiple sectors. When interest rates rise, borrowing costs go up. Imagine that same bakery facing higher rates. The owner might think twice about that new oven or hiring more staff. This can lead to slower growth, fewer innovations, and even layoffs if businesses can't keep up with their expenses. So the movement of interest rates can either fuel growth and creativity in the economy or put a damper on it. Understanding this connection helps us see how deeply intertwined our financial decisions are with broader economic trends. Curious about how these rates ripple through other areas? Don't forget to subscribe for more insights. How do interest rates actually influence inflation? It might surprise you, but interest rates are like a thermostat for the economy. When things heat up too much, central banks can turn the dial, so to speak, to bring the temperature back down. Imagine you're cooking a pot of stew. If the heat is too high, the stew might bubble over, creating a mess. This is similar to an economy that's growing too quickly. Prices start to rise uncontrollably, and that's inflation. Just as you'd adjust the stove's heat to simmer instead of boil, central banks adjust interest rates to cool things down. When inflation starts to rise, let's say prices of goods and services are climbing, central banks often respond by increasing interest rates. Higher rates mean that loans become more expensive. For example, if you want to buy a new car or a home, you might think twice if the loan costs you more. This slowdown in spending can ease demand, which is essential because lower demand helps stabilize or even reduce prices. Here's the surprising part. The relationship isn't just about spending. It also influences how businesses operate. Higher interest rates can lead to fewer investments in expansion, hiring, or new projects. When borrowing costs rise, businesses may choose to hold off on that new factory or equipment. This, in turn, helps to cool off the economy further, reducing inflationary pressures. So when you hear about interest rates increasing, it's not just about borrowing costs. It's a strategic move to keep inflation under control, ensuring that our economic stew doesn't boil over. Understanding this connection helps clarify why central banks make the decisions they do. After all, maintaining price stability is crucial for a healthy economy. How do interest rates pull the strings of the entire economy? Think of interest rates as the temperature gauge in a car engine. If it's too hot, the engine can overheat, leading to breakdowns. If it's too cold, the engine struggles to perform. Central banks, like the Federal Reserve, adjust interest rates to keep the economy running smoothly, much like a mechanic fine-tuning that temperature gauge. When interest rates rise, borrowing becomes more expensive. Imagine you want to buy a house. If your mortgage interest rate goes up, you'll pay more each month. This often leads to fewer home sales, cooling off the housing market, and slowing construction projects. On the flip side, when interest rates drop, borrowing becomes cheaper. That same house looks a lot more affordable, encouraging more buyers to jump in. This boost can stimulate the economy, creating jobs and increasing consumer spending. Here's the surprising part. These adjustments ripple through the entire economic landscape. When businesses see increased consumer spending, they may invest in expansion, hire more employees, and increase production. Conversely, high rates can lead to cautious spending and investment, stalling growth. Central banks aim for a balance. Too much inflation can erode purchasing power, while too low inflation might signal a sluggish economy. They use interest rates as a lever to influence both, trying to keep economic growth steady and sustainable. Understanding this connection between interest rates and the economy gives you a clearer view of how all the pieces interact. And if you found this enlightening, consider subscribing for more insights.